There is something deeply, like almost primally comforting about the physical weight of concrete.
Oh, absolutely.
Like when a foundation is poured and it finally cures, you can walk right up to it, run your hand along the wall, and just know exactly where it stands.
Right. It displaces physical space. It strictly obeys gravity.
Yeah, exactly. If you own it, you can just point to it and say, that's mine.
Because it's fundamentally grounded in tangible reality. And really, for the entirety of human financial history, that tangibility has been the ultimate proxy for safety. I mean, physical mass basically equates to financial security.
But then you look at the modern alternative. You open up a dashboard on your laptop and just watch capital moving globally at, well, the speed of light.
Completely invisibly.
Right. Millions of dollars of value being locked, borrowed, yielding returns in fractions of a second. And there isn't a single brick being laid or an ounce of physical material being moved. It exists entirely as math, just executed by these decentralized networks.
And right now, both of these realms, the heavy tangible reality of the physical asset and the completely invisible instantaneous efficiency of the digital protocol, they are competing directly for the exact same thing.
Which is your capital.
Exactly.
Your capital.
Well, welcome to your deep dive. Today, we are looking at a single laser-focused source that you shared with us. It's excerpts from an article titled Concrete Foundations versus Digital Vaults.
It's a really fascinating piece.
It is. And our mission today is to deconstruct this massive modern financial showdown. We're hunting for where true passive value actually resides in today's landscape. Okay, let's unpack this. We are essentially pitting the traditional friction-heavy world of physical real estate directly against the cutting-edge, mathematically enforced world of decentralized finance.
Yeah, and we need to ground this immediately by just understanding the source's core ambition here. Because this isn't just a basic comparison of, like, who has the better yield rate.
Right, it's deeper than that. Much deeper. The source is fundamentally questioning a long-held assumption about the whole architecture of wealth. It's asking whether the historical safety we inherently associate with physical assets can actually survive the sheer, uncompromising capital efficiency of modern digital algorithms.
So let's start with the heavy stuff. To really understand this showdown, we have to first look at the modern evolution of the oldest asset class mentioned in our source, which is real estate.
The concrete foundations.
Exactly. Specifically, the source examines rental yields derived from what it calls fractionalized office blocks.
Right.
Now, I think we all kind of know the premise of fractionalization, taking a massive, totally illiquid commercial property and slicing it up into tradable digital tokens.
So you don't need, $100 million to gain exposure to that asset class.
Exactly. You're basically buying a single doorknob or like one specific brick on the 40th floor of a corporate high-rise.
Yeah, the intention of fractionalization is really to democratize access and increase liquidity. You are theoretically extracting the financial benefit of the real estate, which is that monthly rental yield, while totally abstracting away the operational friction of buying and selling an actual skyscraper. You just hold a token in your digital portfolio.
Right, but here's where I want to push back on that premise a bit.
Yeah.
Because the source explicitly pairs these fractionalized office blocks with the concept of property maintenance overhead.
Oh, yes. The overhead doesn't magically vanish.
Exactly. That friction doesn't just disappear because the ownership is digitized.
Yeah.
Like, if you hold a token representing a fraction of a commercial high-rise, you aren't just holding a static financial instrument. You are buying into what is essentially a managed biological ecosystem.
A biological ecosystem. That is a really precise way to frame it, because an ecosystem requires constant metabolic energy just to survive.
Right. If the HVAC system on that 40th floor catastrophically fails in the middle of a July heat wave or, a main pipe bursts in the foundation, your token doesn't fix that.
No, it certainly doesn't.
The building requires constant physical intervention. You need plumbers, roofers, property managers, legal teams dealing with tenant disputes. So my question is, if your yield is constantly being siphoned off to pay for all this physical entropy, can we ever genuinely call those returns passive income?
What's fascinating here is how deeply ingrained the psychological anchor of physical durability is in the investor mindset.
Oh, totally.
The brick-and-mortar aspect gives us this immense, really visceral sense of security precisely because we evolved in a physical world. We implicitly trust things we can touch.
Right, I can knock on the wall.
Exactly. But as the source acutely points out, the physical world is entirely subject to the laws of thermodynamics. I mean, entropy always wins.
Always.
Gravity, weather, daily wear and tear, temperature fluctuations, they are constantly degrading the physical asset from the very moment the concrete is poured.
So the passivity is effectively just a localized illusion.
Pretty
You, as the token holder, might be passively sitting on your couch, checking a dashboard on your phone, but your yield is supported by a massive, highly active supply chain of human labor and material replacement.
And all that labor eats right into your margin. The property maintenance overhead mentioned in the source is basically the physical tax you pay for tangibility.
The physical tax. I like that.
Yeah, it's the difference between your gross yield and your net yield. When you rely on brick-and-mortar assets, you are inherently accepting that your returns will always be dragged down by the friction of physical reality.
Because your capital is tied to an asset that is actively decaying.
Right. Which means a significant portion of the cash flow must be continuously redirected back into the asset just to maintain its baseline value.
It's like running a powerful engine that has a slow, permanent oil leak. It generates power, sure, but you are continuously forced to buy more oil just to keep the machine from seizing up.
That's a great analogy.
The physical durability of the concrete foundation is undeniable, but the passivity comes at a major premium. You are paying a heavy toll to reality itself.
Which is exactly why the source forces us to look at the other extreme. If the physical world carries this unavoidable drag of maintenance overhead, the logical countermove is to seek out an asset class that has been completely stripped of physical form.
Just removing the entropy entirely.
Exactly.
Here's where it gets really interesting, because the source points us directly toward the algorithmic returns generated by over-collateralized stablecoin vaults. If physical friction is the problem, decentralized finance is the engineered solution.
And we really need to look closely at the mechanics of that engineering because it represents a total paradigm shift in how capital is deployed and protected.
Let's break down the structural implications of these vaults. The course talks a lot about the hyper-efficient velocity of decentralized lending.
Yes, velocity is the key word there.
Because in a traditional setting, if you want a loan against an asset, you deal with a bank, a loan officer, credit checks, days of waiting, legal contracts. But in DeFi, you are interacting directly with a smart contract, which is just a piece of self-executing code.
No humans involved.
Right. It's like a high-tech robotic pawn shop. You deposit a volatile digital asset, like, say, Ethereum, into the vault as collateral. And then the protocol allows you to mint or borrow a stablecoin pegged to the US dollar. But the key here, the really important part, is the over-collateralization.
Correct. And that over-collateralization is the mechanism that essentially replaces the human underwriter and the entire legal system.
Wow.
Because digital assets can be highly volatile, the algorithm demands a massive buffer. If you want to borrow, say, $1,000 in stablecoins, the vault might mathematically require you to lock up $2,000 worth of Ethereum.
Right. So it's incredibly capital inefficient on its face. You have to already have wealth to unlock liquidity.
You do.
But the source argues that this capital inefficiency is the exact price you pay to achieve that hyper-efficient velocity. Because the vault is over-collateralized, there's absolutely no need for credit scores or debt collection agencies or even human trust.
The math enforces the solvency of the whole system.
Right. If the value of your collateral drops below the required threshold, the protocol doesn't call you to negotiate. It doesn't send a warning letter in the mail.
It instantly liquidates your position.
Just boom, gone.
Gone. And this is where the velocity truly separates itself from the physical world. A liquidation bot, which is just another piece of software scanning the network, detects that your collateral ratio has fallen. It triggers a function that automatically sells your collateral on a decentralized exchange, pays back the vault's debt, and takes a small fee for doing the work.
And how fast does that happen?
This entire process, from the price dropping to the debt being cleared, happens in a single block on the blockchain. We are talking about maybe 12 seconds.
12 seconds. That is wild. It's a perfectly sealed vacuum chamber. Without the friction of physical buildings, property taxes, or eviction courts, the capital moves with literally zero operational drag.
Completely frictionless.
So the people providing the liquidity to these vaults earn those algorithmic returns because the system operates with absolute ruthless efficiency. But I have to stop here and look at the counterweight the source provides, because you can't just remove all friction without introducing a new vector of vulnerability, right?
Absolutely cannot. There is always a trade-off.
The source drops a very heavy phrase into the middle of this frictionless digital utopia. And that phrase is smart contract risk.
Yes, the digital equivalent of the roof caving in.
Right. If we've removed the physical entropy and the slow decay of the building, haven't we just concentrated all of that risk into a single, highly acute point of failure in the code?
This raises an important question, and it is really the crux of the debate over where true passive value lies. When you remove the physical foundation, you are entirely dependent on the architectural integrity of the mathematics.
Right.
A smart contract is, at the end of the day, just code written by humans, and code is susceptible to logical flaws.
But it's not just a simple glitch, right? We aren't
Yes.
talking about needing to reboot your computer or refresh a web page. We're talking about systemic exploitation.
Exactly. Let's look at the mechanics of smart contract risk, because it is fundamentally different from a physical building failing. In DeFi, protocols rely heavily on composability.
Composability, meaning they stack together.
Right. They are often described as digital Lego blocks. A stablecoin vault might be generating its yield by taking the collateral and depositing it into a completely different lending protocol to earn interest.
Okay, so it's outsourcing the work.
Yes. And that second protocol might be relying on a decentralized oracle, which is basically a data feed, to tell it the real-time price of the assets.
So the protocols are heavily nested. They are stacked on top of each other, constantly communicating and moving capital autonomously without us doing anything.
Yes, and that composability is exactly what creates the hyper-efficient velocity, but it also creates cascading systemic risk.
Because if one block falls,
The whole tower comes down. If there is a microscopic vulnerability in the code of just one of those integrated protocols, say an integer overflow bug, or some obscure flaw that allows a hacker to manipulate the Oracle price feed for a single second,
just 1 second.
the damage isn't localized to a single room. A hacker can execute what's called a flash loan, manipulate the price data, convince the smart contract that the vault's collateral is suddenly worthless, and just drain the entire vault.
Oh, wow. And because it all happens at the speed of code, the money is gone before a human being even realizes the attack has occurred.
It is instantaneous, irreversible, and total. There is no insurance adjuster who comes out to survey the damage a week later. There is no physical land left over to sell at a discount. The vacuum chamber seal breaks, and the capital simply evaporates.
Which fundamentally reframes how we have to think about risk. Like with the fractionalized office block, if a pipe bursts and floods 3 floors, it is absolutely a financial loss. But it's a slow leak.
Right, you have time.
Yeah, the property manager shuts off the water main, calls a remediation team, and you replace the drywall. Your yield takes a hit for the quarter to cover the maintenance overhead, but the skyscraper is still standing. The concrete doesn't just vaporize overnight.
The physical world gives you the luxury of time. It degrades slowly. But in the digital vault, the risk is completely binary. The smart contract is either perfectly secure and functioning flawlessly, or it is utterly compromised and the asset goes to zero.
There's no middle ground.
None. You are completely eliminating the chronic slow bleed friction of property maintenance, but in exchange, you are absorbing the acute existential threat of a catastrophic exploit.
It really makes you question what the word passive even means in this context. With the digital vault, sure, you don't have to worry about a roof leaking, but your passivity implicitly relies on a small team of anonymous software developers and security auditors having written mathematically perfect code.
Which is a tall order.
Exactly. Your peace of mind is entirely delegated to an unseen architecture.
And unless you possess the highly specialized technical literacy to personally read and audit complex programming languages like Solidity or Rust, that architecture operates as a complete black box to you.
Which brings us to the ultimate showdown the source is setting up. We have isolated the mechanisms and the structural implications of both sides. We have the constant dragging maintenance friction of the concrete foundations on one side and the sudden catastrophic coding flaws of the digital vaults on the other.
Yes.
We are weighing physical durability directly against hyper-efficient algorithmic velocity. So what does this all mean for you, the listener, trying to actually allocate your capital? I mean, it's like deciding between booking passage on a slow, incredibly sturdy cargo ship versus strapping yourself to a lightning-fast but highly experimental drone. Which vehicle is actually better for your passive journey?
If we connect this to the bigger picture, the source is forcing us to abandon a very comforting delusion. The quest for true passive value is not a search for a magical, risk-free asset that effortlessly prints money while you sleep.
Sadly, no.
Passivity, in the purest, frictionless sense of the word, simply does not exist.
It's an illusion.
It is entirely an illusion. What you are actually doing is choosing your preferred taxonomy of risk. You are deciding which specific type of vulnerability you are structurally equipped and psychologically willing to stomach.
Let's explore that psychological aspect for a second, because I think it drives market behavior more than we like to admit.
Oh, without a doubt.
The brick-and-mortar asset naturally feels safer because human epistemology is completely grounded in physical reality. We implicitly understand a leaky roof. We can easily conceptualize an aging HVAC system. It doesn't terrify us because it is a known, visible problem that can be solved with physical tools and human labor.
Right. We are comfortable with the chronic risk of entropy because we face it every single day in our own biological lives.
Exactly. We are evolutionarily conditioned to manage physical degradation. We know how to patch a roof. We know how to store grain. So when an investor chooses the fractionalized office block, they are actively choosing to pay a known toll.
They accept lower overall yields because a guaranteed percentage of their returns will always be siphoned off to fight that physical decay. They buy the comfort of tangibility, but they pay for it with the cost of maintenance overhead.
But when an investor chooses the decentralized vault, they are rejecting that physical tax. They are demanding the hyper-efficient velocity and the much higher algorithmic returns.
But to get it, they have to step completely out of their evolutionary comfort zone.
Right. They have to accept an invisible acute risk. They are trading the annoyance of a slow leak for the systemic dread of a flash loan attack.
Exactly. You're trading chronic friction for acute fragility. And the source brilliantly exposes that you simply cannot escape the toll. You either pay your toll continuously in physical maintenance, or you pay your toll probabilistically in systemic smart contract risk. The market will always extract its price for passivity.
It really is a profound realization. Whether you choose to plant your flag deep in the concrete foundations or upload your capital into the digital vaults, you are never truly disconnected from the underlying mechanics of the system. You are just choosing which system's flaws you want to underwrite.
And understanding the precise mechanics of those flaws, whether it's the capital expenditure requirements of commercial real estate or the composability risks of DeFi, that is exactly what separates a reactive observer from a strategic participant in modern markets.
Absolutely. Well, thank you for taking this deep dive with us today. Immersing yourself in the actual mechanisms behind these high-concept financial shifts is exactly how you stay ahead of the curve, rather than just reacting to the surface-level yields.
It really is the only way to accurately price the risks you are taking.
But before we wrap up, there's one final lingering thought we want to leave you with. Something for you to mull over that builds directly on this dichotomy between concrete and code. We have spent this entire deep dive treating the physical asset and the digital protocol as two separate, isolated universes, right?
Right, the heavy foundation over here and the frictionless algorithm way over there.
But the trajectory of financial technology suggests those two realms are actively on a collision course.
Oh, they definitely are.
Think about the rise of real-world assets, or RWAs, being tokenized on-chain. If fractionalized real estate relies increasingly on decentralized networks to manage its complex ownership records, and those hyper-efficient stablecoin vaults are increasingly collateralized by the actual deeds to physical buildings, will the stark line between physical durability and algorithmic velocity eventually vanish entirely?
It is a fascinating convergence because you are essentially taking the physical entropy of the concrete and wrapping it directly in the acute fragility of the smart contract.
Right. Imagine a physical skyscraper whose ownership and capital flow are entirely governed by an immutable smart contract. What happens if the protocol gets hacked and the blockchain permanently records that a malicious actor now owns the asset, but the physical building is still standing there in reality, full of confused tenants?
Or, conversely, what happens when an oracle glitch tells the blockchain the building is perfectly fine and continues to pay out yield, but in physical reality, the foundation has completely cracked and the building is condemned?
It's a mess. We started by talking about the heavy, satisfying pour of wet concrete versus the invisible math of the digital ether. But what happens to your passive value when the concrete is quite literally managed by the algorithm and the friction of the physical world collides head-on with the speed of the digital one? That is something to think about.